What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Album, and today I'm joined by Michael Episcope, who is the principal at Origin Investments. And Michael's going to be talking to us today about his role in doing ground-up multifamily development in today's current market conditions. We're also going to be talking about inflation and qualified opportunity zones. So let's get into it. Michael, thanks so much for taking the time to hang out with me today. I really appreciate you coming on.
Thanks for having me, Michael.
Oh, my pleasure. So I know a little bit about your background, but I would love if you could share just a quick and dirty spiel, who you are, where you come from, and what is it that you're doing today in real estate?
Yeah, I always said the quick and dirty. So I'll take you back. Well, I'm co-CEO of Origin Investments. We're a real estate investment firm located in Chicago. We primarily focus on ground up development in what we call the Smile States, tax friendly, climate friendly, business friendly states. Even though we're located in Chicago, we don't do any investing here. In my real estate career, if I want to, take you kind of far back, started, God, I didn't realize this, but I was about 10 years old. And I used to go and work for my grandfather in the summer. And he was somebody who was pretty gritty, bought buildings in the west side of Chicago. And if anybody knows the west side of Chicago, it's not a good area. It hasn't been a good area, never was. And he bought buildings out of tax sales. And that was at a time when people didn't pay their taxes. You can go in there and buy, a 25-story building for $100,000. And that's what he did. And in order to run those, though, you had to be hands-on. You had to be gritty. And so I used to spend my summers with him. And then I had another friend, too, that his dad was in construction. So I loved swinging hammers and the bricks and sticks and putting up garages and things like that. And didn't get paid much. He'd throw me $20 at the end of the day, which felt great. You had fun building things. Yeah. And then, it kind of, I left that industry. Obviously, I wasn't in it, as an employee or even thinking about it, but I got my feet wet there. Went to college. I studied finance and econ at DePaul. I got a job at the Chicago Mercantile Exchange when I was about 19 years old, and I was a runner, and that's kind of the lowest position you can hold down there. And I loved it. I thought it was amazing. It was just like nothing I had ever been exposed to, and I pushed all my classes tonight and started what I'll call my first career at a very young age. And again, I didn't realize that it was my career, but I had stayed in there for 7 or 8 years till I got an opportunity to trade at the age of 27. So I'd worked my way up from a runner to a clerk to a broker, and really didn't love anything I was doing, and I wanted to try my hand at trading. And I got an opportunity, and it turns out I was pretty good at it. So I did that for 9 years and ended up just building more wealth than I had ever set out to. And when I was done with my career, I was married. I had 2 kids. I had another one on the way. My risk profile had changed, and I literally decided I don't want to do this anymore. I don't want to be leveraging myself 300 to 1 every day and have, be always faced with the potential for a 4 or 5 standard deviation, because the bigger you get trading, those moves can wipe you out. And I've seen guys literally, lose everything in these moves. So I punched out of that career in 2005. I stayed home for about 3 months, and I think my wife thought I was retired at that time. So I quickly, I sort of started at what I'll call a family office, but I also enrolled in the Masters of Science program at DePaul, right, to really retool. I knew this is where I wanted to go into real estate to grow my wealth, to build passive income. Because when you get out of one career, and I know a lot of people out there are in the same boat, you're asset rich, but you're kind of income poor. And how do you turn your assets into income? How do you do it in a very tax efficient manner? And real estate is one of the greatest avenues to be able to do that. And I never loved the stock market. Bonds didn't pay enough, and figured my partner and I got together in 2007. Candidly, we didn't have a lot of great experiences out there investing our own capital. And we just said, look, we can do better than this. Let's do it together. Let's pool our money. Let's build something together. And we did. And that's what it was in the beginning. And it started out with the 2 of us. In 2007, we syndicated a couple deals. In 2008, 2009, started building the high net worth investor base, launched our first fund in 2011, launched the next fund in 2013, the next fund in 2016. And so today we have 4 open funds. We've closed 4 funds. We have close to 3,000 high net worth investors. $2.5 billion in assets under, assets, which is the total value of the real estate. And, we're considered a top decile manager for all of our performance. So it's been a fantastic run. That's probably a lot more than you wanted in this quick, but it's hard to condense all that, because I think the story from how I started to how I got here sometimes doesn't connect unless I share those early days with you.
No, it's so good. So I'm just curious, Michael, you started with multifamily, or that's kind of where you ended up?
It's more or less where we ended up, where we gravitated towards. And in 07, 08, I mean, you can think of us more like a family office. We were two guys trying to put our money into real estate, and we were buying deals. And at that time, we were buying distressed notes. The world looked very different, though, in 08. In 08, capital had all the leverage. Everything was trading so far below replacement cost. We were buying bank loans, and it was more of a pricing exercise, which fit perfectly for us because we wanted to protect our wealth. We wanted to manage it. We were looking for big edge in the market, and that was the way that you were able to find it. And when we launched our first fund in 2011, the debt space had sort of dried up, right? The distressed debt. And throughout that entire exercise of buying debt, what we really gravitated towards was value add, buying things cheap, fixing them up, adding value. And so that's what our first fund was about, but it was really agnostic in terms of asset class. So we did everything from industrial, retail, multifamily, even student housing in that. And then fund two was a little bit narrower. Fund two was multifamily, office, and industrial. Fund three was office and multifamily. And today we've sort of narrowed the world down to multifamily only. And the reason is what I talked about earlier, is that in the beginning, capital had all the leverage. And then as the world normalized and things started to trade at or above replacement cost, you really have to understand how to win at the margins. And the only way to do that is by setting up operations in a way where you can buy at scale, that you know every penny, nickel, dime, and when you're pricing things, like, you are true experts. And for us as an investment firm, just making sure that all of our technology, our people have that institutional knowledge and they can bring it with them every day. And it's hard to do that. If you're as big as Blackstone, you can have these massive divisions that are huge, companies in themselves. But for a company like us, I can't look people in the eye and say, yeah, we're the best at industrial, and we're the best at student housing, and we're the best at multifamily. And what I love about the real estate market, it really is dynamic. And we say market, but what do you mean by that when you say the market? Is it self-storage? Is it multifamily? Is it industrial? Is it ground up? Is it value add? Is it the debt space? And I just, there is, I guess, what we would quote unquote call a market out there, but there's so many different avenues that you have to choose where you want to play. And there's no wrong answer. You can make money anywhere in this market.
Love it. And Michael, you've mentioned this concept twice now, and I want to come back to it for our listeners that might not be familiar with it, but you said that it was cheaper to build, or you were buying properties at less than replacement cost. What does that mean, and why is that impactful?
Well, if you think about the Great Recession, what came out of there, prices reset everywhere. And one of the governors in real estate investing is replacement cost. Generally, as you bump up against it and you go, above replacement costs, new supply is going to come in because of the fundamentals. If you can build for a multifamily project, and we do a lot of this, for $270,000 a unit, you'd rather build in that case than go out and buy something that's 10 years old for $300,000 a unit, right? Yeah. Eventually, the fundamentals prevail. What came out of 08 is that the market was so distressed that if the market, properties that were 3, 5, 7 years old, even 20 years old, were trading 50% of replacement cost, 40% of replacement cost. In some cases, we were buying some Class C. We don't operate in that today, but some of those deals were too good to pass up. Were we buying, in the Atlanta market, $15,000 a unit, where if you were trying to build brand new, even back then, those would have been $150,000, $180,000 per unit. They were a little bit on the rougher side, so replacement cost is maybe a little bit, not at play there. But when you're buying buildings 10 years old at half the value of replacement cost, and you can lease those up, that's a great way, kind of a barometer to, when you're out there investing money. And when the market is trading like that, especially what happened in 09, 10, 11, no shovels went into the ground for years. Because why would you build brand new when you can buy something that is a few years old at such a discount to what you can build for today? Because ultimately, if you build, you have to get rents that support those higher costs. And so we were really well protected at that time. But the market ultimately caught up. And then we saw buildings start to take off in certain markets, in the higher growth markets that were undersupplied in 12, right? That was the very early stage of development. And then 13, a little more, 14, a little bit more. And then it's taken off. And today, because the market is so undersupplied, you see a tremendous amount of new construction happening across both single family rentals or single family homes and multifamily.
Yeah, it's so interesting. And just out of curiosity, how long do you think it's going to take to get caught up before we see kind of a more equilibrium?
It's got to be 2 to 3 years. I mean, the supply chain logistics, COVID set us back. But right now, we need to deliver about 500,000 units a year just to keep up with current demand. And we're delivering about 300,000 units of current demand. So between single family homes and apartments, we're still way undersupplied on both sides. And what's interesting right now that's going on the multifamily side is that a lot of millennials are trapped renting, because we all know what's going on with the interest rate side. Well, it definitely, the financing costs hurt us, but what's helping is that it's actually driving demand for apartments, because millennials can no longer afford to buy a house. Because even as much as construction prices have come up for the projects that we've been building, it's 35% more today than it was 18 months ago. That calculus holds true also for single family homes. You add on top of that mortgage rates, 30-year mortgage rates that have gone from 3% to 5%. They've gone up 70% in the last year. Millions and millions of individuals can no longer afford to buy a house and are stuck renting. So that's really creating these kind of anomalies in the market right now. They'll eventually work their way out. And that's why, from our perspective, you want to own quality, you want to own newer, you don't want to be chasing something. I think that those who are buying existing properties today above replacement cost, there's a short runway to make money. And then you're going to see the water settle.
Interesting. Okay. And so what would you say to newer investors that are running up against that issue? They're going to look at the properties, where the prices are, where the cap rates are, and they're getting their insurance quotes, and they're seeing this disconnect between the replacement cost and the purchase price. What do you say to those folks?
Tread lightly in those situations, because here's the thing: everything works on paper, and when you look at historical norms, they all look great. But ultimately, the fundamentals do prevail, and this is why we're not in the value add space today. We haven't been in for 2 years now. Certainly, that's been a mistake. Anybody who was buying value add deals pre 2020 did very well, but we started to see this metric where, at that time, replacement cost was obviously a lot lower. We didn't realize that it was going to be 50% higher in 2.5 years. But the math just didn't work out. We're like, wait, why should we be buying this 20-year-old property at $220,000 a door when and we're going to put another $20,000 into it when we can build for $230, $240, right? Something similar. And we started getting sort of queasy about it then. But the thing that everybody needs to understand is, yes, there are times that if you have barriers to entry and you're in urban markets and there are times that you can buy above replacement cost and you will do fine. But when the world normalizes in 2, 3, 4 years, if you're a long-term holder and you have more and more and more supply that comes into the market, and it will, that older product is going to be the first to suffer. So if you're paying 20% above replacement cost today, and in 5 years from now, buyers have the choice of buying brand new properties at replacement cost, or your property that's going to be 10 to 15 years old, then at above that, they're not going to choose those, right? So that works itself out over time. It's just today we're seeing distortions in the market, and distortions are not good. And it's okay. Like, one of the lessons I learned very early on is one of the best words you can learn in investing is no. Like, let it go. Well, there's always going to be another bus that comes by. So, that's why I say tread lightly. We're treading lightly. We're not in that market at all. We have completely exited buying existing properties, core plus value add, because it's just not a good risk reward in today's market, in my opinion.
Interesting. And it makes total sense. Michael, I want to shift gears here like entirely. As we were talking about before we hit record, the market is super hot. Prices are sky high. And so I think a lot of people are thinking, well, is now a good time to sell? And if they are on that bandwagon thinking it is a good time to sell, where should they be thinking about placing their money? And I'm talking specifically about opportunity zones and the 1031 exchange. So would love if you could talk a little bit about where people should be thinking about placing some of their gains.
Yeah, it's a little bit of a crystal ball. I'll tell you what we're doing. So in our legacy funds, we are selling. We've been net sellers the last year, but we also have funds where we are more of a buy and hold strategy. And markets behave in weird ways. And I'll give you an example. If I would have told you 2 years ago, hey, guess what? There's a pandemic coming and the world is going to shut down and Russia is going to invade Ukraine and the 10-year note is going to, rally from, this rate to this rate. Would you have bought real estate? No, you would have put your head in the sand. Would you have bought the stock market?
Held on as tight as I could.
You would have jumped. Hey, listen, I got this crystal ball. I see all these bad things on the horizon. I'm going to jump into this. So I don't ever think that people should panic. If you have great real estate, the idea is that you want to buy quality. You want to be adequately leveraged so that you can make it to the other side. And the thing about owning real estate is that if you want the real benefits of owning real estate, you have to own it for the long term. And the people who I know who got really wealthy in real estate, they bought it and held it. And the people who I know who got really wealthy in stocks, they bought it and held it. All these day traders, these flippers, things like that, they're just churning money constantly, paying taxes, making a little bit. It's a good living, but I would say real wealth is created by buying and holding quality assets forever. And that's what you have to remember in real estate too, that depreciation, you can't get depreciation if you sell the asset. You can't take advantage of that tax free income. You can't take advantage of refinancing tax-free if you sell the asset, right? It's only if you hold it, let it appreciate. And there's so many reasons, to hold long-term, because as expensive as everything is today, it's going to be more expensive in 5 years and 10 years and 15 years. And if you study what's going on, especially in the multifamily market or even the housing market, there's been no period in history over a 10-year period where multifamily real estate has lost money, institutional real estate. And even through the Great Recession, 08 and 09, I mean, we were almost fully recovered by 2012 on the multifamily side. So, like buy quality real estate, hold it for a while. Now you ask the question, if you're going to sell it, 1031, I don't know, like with the 1031, if you're selling an existing property, you're buying an existing property. Certainly there are 1031s. There's ways to reduce risk. There's ways to reduce headache. Buying some of these triple net mailbox money retail properties is always pretty simple to do versus trying to be an active landlord. Mm-hmm. We do run QOZ funds. I know a lot of investors who can't find 1031 exchange properties. They've been coming into our funds as an alternative. And the difference there is QOZ, the way the law is made up, is it requires us to build brand new. So we are diversified across high growth cities in the Sunbelt markets, places like Nashville and Atlanta and Tampa and Phoenix and Dallas and Austin and places like that. So building brand new, like getting in at a cost basis is, I think, a safer way to invest today. And I know that might sound like an oxymoron. Go into construction to actually have, less risk. What are you talking about? But I will, I would way rather build a brand new property and be in it for $250, $260 a door than go out and buy something that's 3 years old for $400,000 a door. Did I answer your question, Michael? I don't know. That was a long, yeah.
No, it's great. It's great. Well, I'm curious if you could define for people, what is a QOZ? Because I think a lot of our listeners might not be familiar with the term.
Sure. A qualified opportunity zone, qualified opportunity funds came out of the 2017 Tax Cuts and Jobs Act. And it was, there are 8,700 QOZ areas around the countries. And these are maps essentially of low to moderate income areas. Some of them have been adjusted by governors in each state. But really what it allows you to do, if you have capital gains from any source, it can be from stocks, it can be from appreciated art, it can be from a home you sell, an investment property, it doesn't matter. So if you invest into a QOZ fund today, right, let's say you have taxes due for 2021 and you have $1 million gain. If you invest in a QOZ fund today, you don't have to pay those until 2027 because that's when you will recognize those on your tax return for tax year 2026. So there's a huge deferral and there's a value to that deferral because it's basically a zero interest rate loan from the United States government. And during that period, your money is working for you in ground up development, in deals, things like that. But you ultimately have to pay the piper, come 2027. The other benefit that is phenomenal about this program, if you're in the program for 10 years and 1 day, if you're invested in a qualified opportunity zone fund, you pay zero taxes on the gain. So if you double, triple, quadruple your money, you pay zero taxes. And you can be in this program for 10, 20, 30 years. Our fund is designed with optionality. You want to get out in 10 years, you can get out. You want to get out in 30 years, you can get out. So this is a place where I'll tell you, I don't think there's any place better to invest if you have capital gains and you want to be in the real estate, because when you run the math, you have to earn about 50 to 75% more in a non-QOZ investment to get the same after-tax return. So it's exciting. I'm certainly putting a tremendous amount of money into our funds. My partner is as well, but it's one of the best programs that's come about in a while. And Michael, the last thing I'll say about it, I mentioned moderate to low income neighborhoods. The caveat to that, like where we sort of search is along the edges, and those maps are drawn based on the 2010 census. If you think about how much cities have changed since 2010, many of them have changed drastically.
Yeah.
And I'll give you an example, Nashville. We're in Nashville right now. There's an area called the Gulch. And if you were in Nashville in 2010, there was nothing in the downtown area. And it was only in about 2012, 13, 14 that you began to see multifamily residential real estate take off. But before that, it was almost a see-through city. You could see from one end to the other. Now today, it looks like downtown Denver. It is insane. I took a trip with my son this summer and we drove through there again. And I was looking at some of our sites and our properties. Didn't even recognize it because the last time I was there was 3 years ago. And it looks like, something they build in China, it was going up so quickly, right? They're building these cities in like a matter of 8 days. And that's what's going into Nashville. The point is, there's all of that is considered a QOZ area. And those are the areas that we're looking. And you wouldn't know the difference between a QOZ area and a market rate area because to us, a good QOZ development is just a good development. There's no qualifier to it.
Interesting. And so how are people able to find out and take advantage of QOZ funds? Do I just Google QOZ fund Nashville and I'll find them?
Exactly. There's a tremendous amount of information out there. And I would recommend anybody who wants to go, who's active, they should be doing this in a QOZ area and looking at the areas in your neighborhood because it'd be silly. Like, we have some QOZ projects where across the street is market rate development. Now, those are pension funds and institutions that are building those, so they don't care about the QOZ benefits. They only inure to taxable investors. But if you're a taxable investor, you absolutely need to understand this area because to me, it's the best place to gain real estate exposure. So hands down.
I love it. All right, Michael, the last question that I have for you today is curious to get your thoughts about inflation and where things are going and how people should be thinking about it and how you at Origin are thinking about it.
Well, inflation is real. First of all, we've seen this. There's nothing transitory about it. At some point, it will run through the system. I don't know when that is. We watch the yield curve constantly. Some people are calling it inverted. It's more flat today than anything. And if you kind of go out in the yield curve and you look past 23 into 24, it looks like rates are going to remain high until that period and then maybe start coming down. But I just don't see that it can say sustained at this level. And I think once China fully comes back online, we take care of a lot of these supply issues. I think what we have to really be concerned about today, and this would not be a good situation, is deflation. And more I'm reading about that in the market. Deflation is not good, where you have a continued rise in your expenses and things like that, but your demand slows down and you can't raise rents anymore, and your equation just flips a lot. That wouldn't be really good for any investments out there. And I'm not saying that it's going to happen, but it's definitely more of a risk today than it has been in the past. A lot of these inflationary pressures, they will, get solved over time. And right now, it's a difficult period to invest, especially when we're building a brand new ground up multifamily development and we're trying to get to a guaranteed maximum price contract. It's challenging because even oftentimes the general contractor won't fix prices. They won't fix lumber. So we have to leave. And by the way, sometimes we're happy doing that. We're like, look, we don't want to lock in lumber at $1,700 a board foot. We just don't think it is. We'll underwrite to that scenario. We'll leave it out. And that's a place where sometimes we can actually have savings in a project like that. And certainly in a market like this today, it would be great to see inflation sort of ebb for us to be able to, get to a normal place. But it's making it a lot more difficult to do business. I have a friend who runs a lumber company, and he said they used to quote people, and they used to have these quotes out for 3 months at a time. And now at the top of it, when they quote people, 24 hours, they got to get back to them. And I don't think that's a healthy environment for anybody to be in. There's too much volatility. But I would, from an interest rate perspective, it's moving up. I mean, today it's over 290 today. I think with interest rates or with inflation running above 8%, it's kind of surprising it's not at 4 or 5. But I also think that that's kind of a sign to come that inflation will run through, that we're seeing these prices sort of top out. We're going to see some of these supply chain issues get solved, and you'll see late 23, early 24, probably rates come back down, hopefully to 2% or below.
Okay, well, I've got my fingers crossed for that too. Michael, this has been super informative, a lot of fun. If people want to learn more about you or Origin Investments, what's the best way for them to do that and get in contact?
Yeah, so just go to our website, origininvestments.com. We make it really easy for people to learn about us, engage in our content, download our decks, things like that, or connect with somebody at Origin. We have a little pop-up there we use, but you can also just register and then somebody will reach out to you as well. So
sweet. Well, hey, thanks again for coming on. Really appreciate you taking the time. We'll be in touch.
Thank you for having me, Michael.
Hey, you got to take care. Alrighty, everyone, that was our episode. A big thank you to Michael for coming on the show. Super, super informative and really cool to hear what they are doing over at Origin Investments. As always, if you like the episode, please, please, please feel free to leave us a rating or review wherever it is you get your podcast. And we look forward to seeing you on the next one. Happy investing.